this is Tyler Brown, President and Broker of Trinity Homes and Investments. I wanted to reach out today and create this short video to let you know exactly what your options are when you owe more than your house is worth, or you have a distressed situation where you're having a hard time making your mortgage payments. Obviously, there's so many people in this situation based on the economy and the housing market. Really, your choices are a short sale, foreclosure, a loan modification, an attorney lawsuit against the bank, a refinance, a deed in lieu of foreclosure, or bankruptcy. To go through these in a little bit more detail, some things to consider when you're looking into a short sale. Obviously the credit. I think that's what people talk about all the time. I think unfortunately people say that a short sale will save your credit. Please know that a short sale is typically still going to damage your credit, just much less than a foreclosure is. On a credit report, there's really two sections. There's a collection section and there's a public record section. The collections is where if you had a medical collection, a payment that wasn't made, and they sent it to collections. This is really where a short sale ends up. They show it as a charge-off or settled for less than what was owed. When something's in the collection category of a credit report, you can really dispute that with the credit bureaus, and that's how you can repair your credit quickly, as opposed to a foreclosure, which is in the public records category. When you file for bankruptcy or you have a foreclosure filed, it gets recorded with the county, public record. So there's really no disputing something that's been publicly recorded. Another thing to consider is the taxable liability. Is the bank going to send you a 1099? I hear that question all the time, and my answer is yes. 100% of the time, they're going to send you a 1099. It's automated on their computer system. The question is, have you been proactive to speak with your CPA to know whether you have to pay those taxes, if that's really a taxable issue when you receive that 1099? Some things to consider, and you can Google this. Go to the IRS's website. It's the one thing in the IRS's website that's actually easy to read and understand. The Debt Relief Act of 2007. Again, the Debt Relief Act of 2007. This talks about someone that is dealing with a primary residence, the home that you live in. If you have a home that you live in and you do a short sale and the bank forgives debt and a 1099 comes across, the Debt Relief Act of 2007 says you don't owe federal taxes on that. Now here in the state of California, the state hasn't opted into that, so you could potentially have some state tax liability, but really with a 5 to 10% state tax liability, if you have a $10,000 loss and 10% of that is $1,000, it's much better than the alternative in most cases. That being said, there's also insolvency, which says that if you have a zero or negative net worth, that you have a way out of that tax liability as well. Well, what happens if it's a cash out refinance that you have, or if it's an investment property and you don't qualify for the Debt Relief Act of 2007? Again, be proactive, talk to your CPA. If you have an investment property with a basis, what it was purchased for, of $100,000, and now it's sold for $50,000, and at $50,000 you sell that property as a short sale, and the bank sends you a 1099 for $50,000, their loss. Couldn't you say that as an investment your basis started at $100,000 and you lost $50,000 on your basis? So that $50,000 of gain should be offset by that $50,000 loss. Obviously, there's the potential for, in a short sale, for the bank to have right to pursue for a deficiency judgment. Meaning that if they lost $50,000, they have the right to, after that closes, sue you and try to collect that loss. Now, while many people and attorneys alike suggest that this is very unlikely, I don't like to move forward on unlikely situations. I like to try to make those as permanent and to know that you've avoided a bad situation. So in a short sale, you actually have the ability, we have the ability to negotiate with that bank. If they give us an approval letter, which is really your contract on that settlement, that says they have the right to pursue for deficiency judgment, we can usually negotiate that out of that approval letter. It's never a guarantee, nothing is in this real estate market, but we really have the prowess to negotiate and have the ability to make that move and better the terms in the situation, as opposed to, and this is a segue, to foreclosure, just letting the property go. California is what's called an anti-deficiency state, which means that if the loan that you have is the loan that you use to purchase the property, whether it's a first and a second, but the loans were used to purchase the property, and you go to foreclosure, the bank has no right to come after you. They have no legal action to sue you for that loss. So many misconceptions, and again, all I do is short sales, but many misconceptions on the short sale side is that short sales are automatically better than a foreclosure. Well, in a short sale situation, if you agree to a short sale approval letter that says we have the right to sue you, you're not protected against that anti-deficiency law. Again, consult with your attorney, but that's my understanding. We use that to negotiate that verbiage out of your short sale approval letter. But again, we're going to be honest with you to let you know what the situation is so we can work through and find out what's best for you and your family. The other thing about a foreclosure, obviously the deficiency, if you're not covered by the Debt Relief Act and you have that deficiency judgment and there's a loss, the loss is usually going to be greater. I read that on average a foreclosure costs a bank about $50,000 just in legal fees to have the attorney file the paperwork, to have all the things that happen on the legal side. They have to have a trustee. A lot of things have to be filed with the county. So just to go through that process is typically an average of $50,000 cost to the bank. Then they have to hold the property for average 3 months, maybe some repairs, and they're usually going to have to sell it at a discount, especially if it's vacant and vandalized, things of that sort. So usually in a foreclosure, the bank's loss is going to be much more, which makes your liability chances much higher.